Talk to any property investment expert and they'll tell you that a great part of property is maximizing their tax deductions through depreciation claims. By depreciating the value of their investment property, investors are able to reduce their taxable income and therefore increase their overall returns. But it's often a misunderstood topic, and I find that so many investors don't know where to begin when it comes to navigating all the ATO jargon. In fact, statistics show that 70 to 80% of investors in Australia aren't taking advantage of tax depreciation, despite being one of the most effective cash flow tools available to investors. So, I want to give you a basic insight into what it is and how it can benefit you. Because as an investor myself, I can tell you that you're definitely losing out if you're not claiming depreciation deductions. So, what exactly is property tax depreciation? In a nutshell, depreciation is based on the wear and tear of your property over time, and it can be claimed on both the building itself and the fixtures and fittings within it. For investors, this provides a valuable opportunity to reduce their tax liability and increase their profits because it's a non-cash deduction, which means you don't actually spend any money to claim the expense. There are two types of claimable depreciation deductions: Division 43 capital works and Division 40 plant and equipment. Division 43 deductions refer to the depreciation of the building's structure. You can also claim a capital works deduction on construction costs. Your capital works deduction is dependent on two things: when it was built and the type of building you own. For example, a residential building purchased after the 16th of September 1987 will depreciate at a rate of 2.5% each year for the next 40 years from the date of construction. The same rate applies to offices, warehouse, and other commercial buildings. The term plant and equipment refers to fixtures and fittings that are found within the building. These are generally items that can be easily removed, like ovens, fridges, flooring, air conditioning units, etc. Division 40 assets offer you an accelerated level of property depreciation due to their nature of being faster wearing when compared with bricks and mortar of the building. So, you can often claim a large number of deductions over a shorter period of time. Unlike capital works deductions, these items depreciate at different rates depending on the ATO's assigned effective life. For example, a carpet wears out pretty quickly, so that has an effective life of 8 years, whereas a packaged air conditioning unit has an effective life of 15 years. It's worth noting though that you can't claim deductions for plant and equipment assets on second-hand properties if they were bought after the 9th of May 2017. In order to claim these tax-deductible expenses, you need to identify the value of the investment property, what you estimate construction costs to be, and all the fittings and fixtures. That's where you may have heard of the term depreciation schedule. The purpose of a tax depreciation schedule is to outline the value of both your Division 40 and Division 43 assets, as well as how much they have depreciated and will depreciate. This will give you a clear idea of how much you can claim for tax depreciation. The tax depreciation schedule document is typically prepared by a professional quantity surveyor who's a member of the Australian Institute of Quantity Surveyors. Qualified quantity surveyors will inspect your investment property and assign a value to each asset. A single schedule provides 40 years of claimable deductions or the maximum entitled years. So you will only have to have your property inspected once. And the bonus here is that the quantity surveyor's fees are also a property tax deduction. Then, once you have your depreciation schedule, all you have to do is hand it over to your accountant, and they will submit the results on your tax return for each financial year. Even if you haven't owned your property for an entire financial year, you should still order your depreciation schedule before the 30th of June of that year so that you can qualify the claim deductions partially and low value pooling. If you have any plant and equipment assets that are valued at less than $1,000, the ATO allows you to depreciate those assets using a low value pooling method. The depreciation of certain low value assets can be calculated by putting them into a low value pool and then depreciating the assets at a set annual rate. This will allow you to depreciate any plant and equipment assets at a faster rate so you can maximize your depreciation deductions. Assets within a low value pool can be depreciated at a rate of 18.75% in the first year and 37.5% each year after that. So there you have it, a basic guide to property tax depreciation. Are you one of the 70% of investors who miss out on the chance to save thousands of dollars each year? If you've answered yes, hopefully you've gained some insight into how you can boost your cash flow almost instantly. And as an investor myself, I'd be happy to recommend some great quantity surveyors to help you with a depreciation schedule, so feel free to reach out. Otherwise, remember to like and subscribe. I'm Steve Palise, author of Residential and Commercial Property Investing Explained Simply. Cheers.